Hello everyone, welcome to One More Thing. I'm Matt. Everyone wants to have a sound financial plan. However, how to start this plan can seem like a difficult question. That's why some people refer to the 10 steps to the money game blueprint as the basis for their financial plan. Therefore, today I want to share with you the blueprint of the money game. This blueprint includes 10 steps so that you can manage your finances and investments more effectively. Let's take a look at these steps. The first step is to sort out your financial goals. You need to determine what your short and long-term financial goals are, such as buying a home, retirement, investing, and more. This will help you make a clear plan and determine the amount of money you need. Assess your existing financial situation, including income, expenses, savings, and debt. This can help you understand your current financial situation and decide which goals are realistic. Depending on your long-term and short-term goals, identify several key financial goals. For example, if your long-term goal is retirement, your key financial goal might be to save enough money to cover the expenses of retirement. If your short-term goal is to travel, then the key financial goal may be to save enough money to pay for the trip. Based on your key financial goals, create specific plans to achieve them. For example, if your key financial goal is to save enough money to cover the expenses of retirement, then you need to create a savings plan, such as saving a certain amount each month. Monitor your progress regularly to make sure your plan is effective. If you find that you're not progressing as expected, you may need to reassess and adjust your goals and plans. The second step is to review your financial situation. It is very important to understand your liabilities, assets, and income. This will allow you to determine your financial situation and develop a financial plan that works for you. Gather all finance-related documents, including bank statements, credit card statements, investment account reports, mortgage and car loan documents, and more. Calculate your assets, including cash, savings, investments, property, and cars. Determining your total asset value can help you understand your financial situation. Calculate your debts, including credit cards, mortgages, and car loans. Determining the total value of your debt can help you understand your total debt and start making a repayment plan. Assess your income and expenses to determine your monthly disposable income and expenses. This can help you understand your standard of living and spending habits. Analyze your portfolio to understand the risks and returns of your investments. If your portfolio is too concentrated or too risky, you may need to rebalance your portfolio. Calculate financial ratios such as repayment ratio, debt ratio, and savings ratio. This can help you understand your debt levels and saving habits. Evaluate your risk management strategy, including insurance and emergency savings. Determine if you have enough insurance and emergency savings to cover unexpected situations, such as accidents or job losses. The third step is to establish an emergency fund. Emergency funds can help you cope with emergencies such as unemployment, illness, car accidents, and more. It is usually recommended to set up an emergency fund that can support you for at least 3 months. Having enough emergency funds can help you worry less about your finances, because you know you have enough savings for any unpredictable expenses or contingencies, which can give you more peace of mind and stability. If you don't have enough emergency funds, you may have to borrow money for unexpected expenses or emergencies. Borrowing money can add to your burden, so setting up an emergency fund can help you avoid unnecessary borrowing. Setting up an emergency fund can also be a goal for your savings. By saving a certain amount regularly each month, you can gradually build up enough emergency funds and develop good saving habits. The fourth step is to pay off loan sharks and credit card debt. Interest rates on loan sharks and credit card debt are usually higher, so you need to pay them off as soon as possible so you can reduce your future burden. First, you need to create a repayment plan that determines the amount and timing of the repayment each month. This can help you manage your debt and ensure that you don't miss a repayment deadline. If you have multiple debts, you need to prioritize paying off debts with high interest rates. This reduces the interest you pay while lightening your burden. In order to pay off your debts, you need to reduce your expenses and save as much as possible. Consider cutting back on unnecessary expenses, such as eating, drinking, traveling, shopping, etc. And reduce unnecessary consumption as much as possible. Another method to consider is to increase revenue. You can look for part-time jobs, side hustles, sell unwanted items, and more, all of which can help you increase your income and pay off your debts faster. Sometimes, you can pay off high-interest debt with the help of a low-interest loan. For example, you can transfer credit card debt to a zero-interest credit card, or pay off a high-interest loan by applying for a low-interest personal loan. The fifth step is to establish a budget. Budgeting can help you control your expenses and ensure a balance between your income and expenses. You can use free budgeting tools such as Mint or Wine app. First, you need to evaluate your income and expenses and determine the amount of income and expenses for each month. This can help you understand how much you're spending each month and whether you're earning enough to cope with the expenses. Create a budget plan based on your income and expenses. This includes setting monthly limits on expenses such as rent, food, transportation, entertainment, clothing, and more. You can use spreadsheets for Excel or a dedicated budgeting app to help you plan your budget. Once you've made a budget plan, you'll need to monitor your spending each month to make sure you're not exceeding your budget limits. You can use a ledger or financial management app to track your expenses and make sure your expenses are aligned with your budget plan. If you find that your expenses exceed your budget limits, you need to adjust your budget plan in time. This could mean cutting back on some expenses, or increasing your revenue in response to unpredictable spending or contingencies. Saving. A budget plan should also include a savings goal. You can set the amount of savings each month and allocate a portion of your income in your budget plan to achieve this goal. This can help you build savings for future unpredictable events or to achieve long-term financial goals. The sixth step is to start investing. Investing can help you achieve long-term financial goals, such as retirement. If you don't know how to start investing, consider using passive investment vehicles, such as index funds or ETFs. Before you start investing, you need to know the basics of investing. This includes understanding different investment types, risks and returns, asset allocation, basic investment strategies, and more. You can read investment books, websites, or consult an investment advisor to learn about this. You need to determine your investment goals. You may want to invest for retirement, buying a home, education funds, and more. Your investment goals can help you determine the level of risk and return of your investments, as well as your asset allocation. You need to open an investment account. You can choose to open your own securities account or invest through investment funds, ETFs, and other investment products. Before opening an investment account, you need to understand the fees required to open and operate the account. You need to choose the right investment products according to your investment objectives and risk appetite. For example, if you want to save for the long term, you can consider investing in stocks, bonds, funds, and more. If you want to be less risky, you can consider investing in solid investment products such as bonds and time deposits. Monitor the performance of your portfolio. You can periodically check the returns of your investment products and make adjustments as needed. This can help you ensure that your portfolio is aligned with your investment goals and risk appetite. Investing is a long-term process that requires patience and long-term thinking. Investing in the market can be volatile and risky. But if you keep investing and are patient over the long term, you have a good chance of achieving your investment goals. The seventh step is to ensure that your risk is properly controlled. You need to determine your investment risk tolerance and choose an investment product that suits your risk appetite. Generally, high-risk investments have high returns but also high risk of loss, while low-risk investments may have less return but lower risk. Diversification is an important risk management strategy. You can reduce your risk by investing in a variety of different investment products such as stocks, bonds, funds, etc. Doing so can help you reduce the risk of a single investment product and improve the stability of your entire portfolio. You need to research the product you intend to invest in and understand its risks and rewards. You can research investment products by reading reports, analyses, ratings, etc. and determine whether they align with your risk appetite and investment goals. You need to monitor the performance of your portfolio regularly and make adjustments as needed. This can help you ensure that your portfolio aligns with your risk appetite and investment goals. If you need to consult an investment advisor, you need to choose carefully. You need to confirm their licenses and experience, and ensure that their investment advice is in line with your risk appetite and investment objectives. In investing, emotional decisions can lead to irrational risk-taking. You need to avoid emotional investment decisions and instead base your decisions on dispassionate analysis and research. The eighth step is to do regular portfolio rebalancing. The value of a portfolio changes over time, so you need to rebalance your portfolio regularly to ensure it aligns with your investment goals and risk appetite. The rebalancing cycle refers to the time interval at which you periodically rebalance your portfolio. This time interval can be determined according to your investment goals and risk appetite. Generally, the interval between portfolio rebalancing can be quarterly, semi-annually, or annually. The threshold for rebalancing is when certain assets in your portfolio are weighted above or below the threshold you set. This threshold can be determined based on your risk appetite and investment objectives. You can set a lower threshold if you want your portfolio to have lower volatility, and a higher threshold if you want your portfolio to have higher returns. The method of rebalancing can be to sell some investment products to adjust the portfolio, or to add some investment products to adjust the portfolio. You need to decide on an approach to rebalancing based on your investment goals and risk appetite. You need to monitor the performance of your portfolio and make adjustments as needed. You can regularly check the returns of your investment products and adjust your portfolio as needed. If you need to sell investment products to adjust your portfolio, you need to understand the relevant tax regulations and implications to avoid unnecessary tax liabilities. You can consult a tax advisor to understand the relevant tax issues. The ninth step is to make sure you have adequate insurance. Insurance can help you deal with unexpected events such as illness, accidents, and more. You need to make sure you have adequate health insurance, car insurance, home insurance, and so on. You need to know about different types of insurance, such as life insurance, injury insurance, health insurance, car insurance, property insurance, and many more. Each plan has different coverage and premiums, and you'll need to choose the plan that's best for you. Before purchasing insurance, you need to determine your insurance needs. This includes your health status, family status, financial situation, occupational risks, and more. You can determine your insurance needs by consulting an insurance advisor or using the online insurance calculator. Depending on your insurance needs, you will need to calculate the appropriate amount of coverage. For life insurance, you need to determine how much coverage your family needs to cover household expenses and pay off debts, among other things. For health insurance, you need to determine the appropriate amount of coverage to cover medical expenses. Before buying insurance, you need to compare different insurance products. You can compare insurance products online or consult an insurance advisor to understand the advantages, disadvantages, and premiums of different insurance products. Your insurance needs may change over time and conditions, so you need to check your insurance regularly and update it as needed. For example, if you have new financial burdens or family members, you may need to increase your insurance amount to ensure that you and your family are adequately covered. In some cases, your basic insurance may not provide adequate coverage. For example, you may need to purchase additional travel insurance to protect against unexpected circumstances during your trip, or rental insurance to protect your rental property. You need to consider purchasing supplementary insurance based on your individual circumstances. The 10th step is to determine your retirement plan. You need to determine what your retirement goals are and determine the amount of money you need. You may consider using a 401k, IRA, or other retirement plan to achieve your goals. Before you decide on your retirement plan, you need to determine your retirement goals. This includes the age at which you wish to retire, how you want to live and spend in retirement, and the level of income you want to earn. You need to consider these factors to determine your retirement plan. Depending on your retirement goals, you'll need to figure out how much money you'll need for retirement. This includes how you want to live and spend in retirement, as well as your life expectancy and inflation rate, among other things. You can use the retirement calculator to calculate the amount of money you need for retirement. You need to determine your source of income after retirement. This includes pensions, social security payments, investment income, and more. You need to determine the amount and stability of these sources of income to determine your retirement plan. Depending on the money you need for retirement and your expected source of retirement income, you'll need to set savings goals. You can achieve your savings goals by saving regularly, investing, etc. You need to make sure your savings plan meets your retirement goals. You'll need to review your retirement plan regularly and make adjustments as needed. Your retirement goals, income streams, and savings goals may change over time. And you'll need to review your plans regularly and make the necessary adjustments. To sum up, these 10 steps can help you build a solid financial plan, and these steps can help you build a sound financial foundation and prepare you for the future. The first step in the blueprint is to establish a budget, which is the foundation of financial management. Next steps include reducing debt, building an emergency fund, investing in a retirement plan, and more. These steps will take time and effort, but if you stick to them, you will be able to build a solid financial plan and achieve your financial goals. Don't be afraid to start. Take the first step now and follow these steps to achieve your financial dreams. Thank you for watching this video. Please like the video and subscribe to the channel. We will continue to bring you more and more valuable videos. See you next time.